Bearish bets backfiring. So we put out a note to you last night by email talking about last week's rally that was just simply caught a lot of people flat-footed. There's been a lot of bearish voices in the market. We've been talking about this now for some time, that you often see the market, and especially market commentators, especially the financial media. This is so important for those of you who are new who don't know this. But the financial media kind of gets stuck in a doom loop whenever the market goes down. They act like it'll never go down, and when it finally goes down, they live in denial. They act like it's, or they'll note it, but they won't really notice it. But then once the market really begins to grind down, then sentiment just really gets low. It gets bad, and people say, "Well, the market's over. It's just not going to go up anymore. It's just over. It's just going to keep going down. It's just going to down, down, down. That's all that's going to happen. It's just going to keep going down," they say. Okay, and so then investors and people watching the news are like, "Oh, what's going to happen? Is it all going to go away? I mean, is it all going to be here?" And so they don't know. And the fear begins to ratchet up. In 2022, for example, just horrific. It was a horrific market. And then, of course, the commentary was, also pretty bad. And you finally drive out all the bulls. At some point, you drive out, and the market capitulates, okay? But the financial media doesn't know this, right? They're not aware of this. They're still living in the world where the market did go down, so therefore it went up this week, but no, it has to keep going back down. Like they're very stuck in their ways. Like, this is what the market has to do now. It has to keep going down because we're scared. Well, the market really doesn't care. The market's going to do its own thing, and it's going to begin to rally, usually well before people are ready for the rally, right? And what happened last week was that we had something very remarkable we haven't seen for quite a while, and that was 5 consecutive buying days. So 5 days in a row. Now, if you go back to and that was in the S&P, that was in the NASDAQ. I mean, across the board. I mean, you saw buying pressure just come out of the woodwork. Now, we've been telling you that we do expect a Q4 rally. We do think that the market very likely could even close at a new high by the end of the year. Now, some might look at that and say, well, how? I mean, look at the media, look at what they're saying, look at all the things that are going on. Look, and this is precisely what we're talking about. Is that the market tends to look forward 6 months ahead, and the market is beginning to realize that the higher for longer interest rate talk, is beginning to lose a little bit of its bite. And it's becoming clear that some of the data is pointing to the fact that the Fed is very likely going to have to begin cutting rates and certainly not continuing to raise rates. That seems to be what the market is beginning to realize. And the way you know that is by looking at the dollar, and we'll look at the dollar in a little bit, and also by looking at bond yields, right? Those are really important. So you're going to look at these and you're going to say, now what's going to happen here? And then also one thing that's been very important has been the Treasury borrowing. And the Treasury borrowing that we saw in Q3 was, off the charts, $1 trillion, the Treasury borrowed in Q3. That came out in July. That was kind of the peak for the market for the year, and then the market started falling because, yield started surging, the dollar started going back up. It had a lot to do with the Treasury borrowing. Well, we told you last time when we got together that the Treasury borrowing came in less for Q4. They're going to borrow $776 billion for Q4. Now, that sounds outrageous. However, the Wall Street was expecting $850 billion, okay? And so they said, well, this is better. And so now suddenly it's changing the trajectory of what's priced in. And so now you're beginning to see the markets now rally. A lot of it has to do with those expectations of Treasury borrowing. So what happened last week was that we saw a massive rally in many ways across the board. I mean, we saw a lot of big, 6% on the S&P, 6% on the NASDAQ. I mean, that's a big week, Well, the problem is that a lot of people, a lot of Wall Street, short sellers had piled into short positions because they said, well, the market has to keep going down. You remember 2022? Remember that? Remember how it went down into, well, it has to keep doing that. Well, not necessarily. And in fact, when you look at the overall market, like look at treasuries, for example. U.S. treasuries declined 17% last year. That's the worst return in over 200 years, right? And they're on course, by the way, for 3 straight years of losses. Now, this has never happened before. When you look at the market history, we've never seen 3 consecutive annual declines in the U.S. Treasury market. But we're beginning to see that there might be some light at the end of the tunnel. So people are kind of stuck in this, in this loop where they say, well, bonds have to keep going down. They've gone down for 3 years. They have to keep going down. Well, no, not necessarily, right? So that's one of the things that we're in. This, of course, led to a big backfiring as a lot of money was lost. A lot of money was lost last week for those who were very heavily short the market. They kind of got a rude awakening here. So, the economy and the stock market are not the same, right? And obviously, there will be times whenever the economy may be doing poorly, but the market is doing well. There may be times when the market is doing poorly, but the economy is doing well. They don't always mirror each other, and so that's really important for everyone to understand.